Hello and welcome to our Stepping Stones podcast, supporting Americans with each step of their unique journey in the UK. I'm your host for today, Scott Barber, a partner here at Buzzacott. Joining me are...
I'm Kristen Konchnik. I'm a tax partner at Butler Snow here in London.
I'm Paul Baker in the Buzzacott Expatriate Tax Services team.
And I'm Liam McKeever in Buzzacott's corporate tax team.
In this episode, we'll discuss setting up a business in the UK. And to get started, let's share the story of our client, Michelle. Michelle is a UK resident with a passion for all things tech. After working in Silicon Valley in the US, she has since moved to the UK and plans to set up her own business here. She's heard about the complications that US citizens can face when they are owners of foreign corporations and is looking for tax and legal advice. She is also uncertain as to whether she wants to remain in the UK for her later years, so is seeking advice on designing an efficient exit strategy from the start. So, the first step she will want to consider is choosing the right business structure and understanding the personal implications of that structure to her. So, Kristen, what are the options for doing business in the UK?
Well, there are a few. Obviously, what we're looking at first is what the UK structures would be. So, does she want to set up a UK limited company, for example? Does she want to use a UK limited liability partnership or an LLP? What is best in terms of what she's thinking? Will she have external investors? What's the business going to be doing? So there's a lot of sort of commercial considerations that will sort of start that process off. But then obviously, and what we are sort of best able to help with is what the tax implications of that are. So, for example, Liam, if we think about, from a UK perspective, is there a preference? What would an entrepreneur who's setting up a business in the UK, what would they typically look to first from a structuring perspective?
Yeah, so typically we often find clients in a similar situation to Michelle's, looking to set up a UK limited company. The reasons for that really are limited companies taxed on its profits, so there's a lower tax cost capital. You're looking at 19% corporation tax. A bite that is due to increase to 25% from April 23.
And that's compared to what, sort of an individual rate of what?
Yeah, in contrast, if you were to go down the LLP route or perhaps just a sole trader, she's looking at personal income tax rates. So you're looking at rates of up to 45%. And then on top of that, depending on where her sort of elections are on Social Security, but UK national insurance.
So really, a UK limited company from a UK perspective would be what we would be thinking about. And so Paul, from a tax perspective, what do we think on the US sort of tax side of that? What are the implications of having a UK limited company for a US citizen?
So there are a lot of things to consider from the US side, and in particular the personal tax side. So where you have a non-US company which is controlled by US people, you have what's known as a controlled foreign corporation for US tax purposes. The default treatment of that, depending on the underlying source of income, is that in the US will look to tax the underlying income of the company as it arises, regardless of whether there's any distributions from the company or not. And that can create double taxation issues because you are limited in what foreign tax credits you are able to give. So that's where we normally explore the options available, and there are certain elections that can be made to mitigate that. So one such election is a check-the-box election. The check-the-box election disregards the entity as a separate legal entity for US tax purposes. What that means is that the underlying income of the company is still taxed on the individual, but you are able to get a foreign tax credit for the UK tax, so for the UK corporation tax, and to the extent that you've paid dividends out from the company, you can take the foreign tax credits for those against that as well. There are other options as well, so there's a Section 962 election. This election works by taxing the underlying profit on the US tax return, but the rate that applies to those is the US corporate tax rate.
Which, of course, at the moment is quite a bit lower than the individual income tax rate in the US.
Further, by making this election, there is currently a deduction which effectively reduces the US tax rate on the income to 10.5%. And then you can claim a foreign tax credit for the UK corporation tax that has been paid, or a certain element of that. And that effectively can, in a lot of situations, reduce the US tax to nil. So whilst it is quite complex, there are options available to the individuals and to Michelle, whereby she could make this Section 962 election. It creates additional compliance work, but the overall tax burden is a lot.
Yeah,
smaller.
I was going to ask, sort of when you guys are looking, and me as well, when we're looking to advise clients, someone comes and says, well, this is what I want to do, and I'm going to set up my UK advisor has told me that I should set up a UK limited company. What do you typically say, well, we actually think that looking at the numbers and everything, even though it's more complicated and the compliance burden is higher, we think that this 962 election makes more sense? Or do you typically sort of go down the check the box route? And obviously there's pros and cons of both of those approaches. One of the advantages of a 962 election is that you can make it one year, not make it the next year, make it the next year, not make it the next year. It's flexible. A check the box election is not really that flexible. It's once you've made it, you are kind of more or less stuck for a variety of reasons. So do you guys, do you sort of have a more or less a default, or do you always kind of look at the, run the numbers and think about it that way?
No, we certainly don't have a default. We have to look at each situation on its own merit, and so we have certainly have some clients who make check the box election. Some people who prefer the flexibility of the Section 962 election.
Yeah.
And we would run the numbers. We'd look at potentially the next few years worth of profits, what they anticipate, and also the exit strategy as well.
Mm-hmm.
And
Yeah.
I think that's really important to understand, that there really isn't a one-size-fits-all solution. One of the considerations, for example, on whether or not to make the check the box is if you have a business that is profitable, but they want to leave the money within the company for growth, that can be a situation where you don't want the income immediately taxed on the individual because they possibly haven't paid sufficient tax on it to avoid paying a U.S. tax charge on those profits. The other difficulty is very much in the current uncertainty of where tax rates are going. With the U.S. rate reasonably low historically on the corporate side, that might point towards not making a check the box election. But as that rate goes up on the U.S. side purely on a domestic basis, it also has an effect on how efficient that will be for someone actually doing business outside of the U.S. And of course, the final wild card, as we've mentioned, is what happens with UK tax rates. In some ways, if the UK rate goes up, you become somewhat more indifferent to the U.S. side because you simply have paid more foreign tax credits on the UK side that can help neutralize that.
That's got another thing that we need to consider as well is whether, Michelle's starting a tech business, is it going to be profitable from the outset? If there are going to be losses in the first few years, certain election, if you're making a Section 962 election, you may not actually have any be paying any UK corporation tax, whereas on the US side, you can't carry forward those losses in that scenario, so you could end up having to pay US tax. And then in that case, maybe a check the box election could be more worthwhile if there's going to be losses, because you can benefit from those losses.
I mean, as you said, Scott, I mean, it's not a one size fits all, right? It's understanding, what the client is planning to do with the business, what they're planning to do with the cash that the business is generating, what's the sort of life cycle of the business, what are they thinking about an exit strategy down the road? So all of those things, I think, are part of that initial discussion of, how are you going to structure this in the first place is sort of a combination of all of those factors.
Yeah, and I think the other thing it's worth mentioning is that the election itself is made on the entity, so that any other Americans who are participating in the ownership will also be bound by that election for as long as it's valid.
The check-the-box election,
Check the box election, and that may also be a disincentive if you're looking to attract pure investors into the company. They almost certainly would not want to check the box election. They simply want to pay tax on their dividends and capital gains when they sell it.
We've talked a lot about sort of the company and the company structure, but is there anything that Michelle should be thinking about from a sort of personal perspective in terms of her personal ownership of the company? Again, kind of taking all these things into account. Does she want to be thinking about setting up a trust? Does she have children? Is she domiciled here in the UK? Is she not domiciled? How long is she planning to stay? Does she feel like these are assets that are going to, she's targeting fast growth? Are these going to be assets that it would be useful to put some of the shares in the UK limited company in trust, at least for a second generation at a time when the valuation is low, and that amount could sort of grow sort of tax-free within the trust. So some other things I think at the shareholder level that really are about her kind of personal planning as well to think about.
Absolutely. And I think, again, a difference that it's worth Americans appreciating is, the U.S. for quite a while now has had a unified rate between capital gains and dividends. So although capital gains are probably preferable for other reasons, overall Americans are reasonably indifferent as to whether they're going to get their reward in the form of a dividend or capital gain. In the UK, that's not the case. The rates of tax on dividends are quite a bit higher. In fact, I don't think it would be an exaggeration to say they're certainly double the US rates, whereas the capital gains rate, at least at the moment, is a reasonably similar 20% if something is structured correctly. So that will, in part of the exit strategy, be a factor that how the company eventually is either sold on or wound up, extracting value. There will be a bias in the UK in favor of getting a capital gains treatment. So if we assume the check-the-box election in this case is not going to be relevant or helpful, Paul, what are the considerations to a company being controlled by an American if they don't have a check-the-box election over it?
So, as mentioned before, the default treatment would be, assuming there was no election, that the underlying income in the company would generally be taxed at the US personal tax rate. And that's due to the global intangible low taxed income rules, which were introduced in 2018. By making this Section 962 election, you can effectively reduce the US tax to nil, and then marry up the UK and US tax point on dividends. So it does help in that sense. But again, you'd have to look at the client's individual circumstances. There's not one size doesn't fit all.
And I think just to kind of point out there are multiple what we call in the U.S. anti-deferral regimes, i.e. rules that are designed to prevent U.S. taxpayers from putting a bunch of assets in a non-U.S. corporation, rolling up the income and not paying any U.S. tax. And one of those anti-deferral regimes, as Paul said, is the controlled foreign corporation regime. And there's sort of two aspects to that. There's the kind of part that's about you are earning what we think is bad income, like passive income, stuff that you shouldn't be putting. You shouldn't put a bunch of stock in a company and then get dividends on that stock into the company. We don't think, from a policy perspective, we don't think that works. So that's one kind of part of this controlled foreign corporation regime, which we call Subpart F. The other part of this controlled foreign corporation regime is what Paul mentioned, which is the global intangible low taxed income, or GILTI, because someone in Congress had a sense of humor. And that's effectively for a tech business, for a business that doesn't have tangible assets, That's effectively all of its income. But there's another, those controlled foreign corporation rules apply in this case because Michelle's going to wholly own the company.
Yeah.
There's another set of rules if she decides to take on investors down the road, if those investors are smaller investors, if they're not U.S. investors, then the other regime that she would need to consider is what we call our passive foreign investment company regime. That really only applies if U.S. people sort of own 50% or less of the company, and it's another sort of unpleasant, probably more unpleasant than the controlled foreign corporation regime, but just something to note that there is, if she thinks, oh, I'd love to get out of these controlled foreign corporation regime, out of these controlled foreign corporation rules, I'm just going to reduce my ownership to below 50%. Then it's not a sort of get out of jail free card, because there's another set of rules that she would need to consider in that case.
In the next step, we'll talk about the basics of setting up a business in the UK. So, Liam, how do you set up a company in the UK so that it's legally and properly constituted?
Yeah, sure. So, actually setting up a company in the UK, in probably international terms, is actually relatively straightforward, and actually can be done. Actually, incorporating the company can really be done within a matter of days. What I have found with some clients, actually, what often comes as a surprise, especially for Americans coming to the UK to set up a company, is the length of time it can actually take them to set up a UK bank account, a UK business bank account. Had one client recently, they spent 9 months with a particular bank, only for that bank, back and forth, only for that bank to reject it, the application right at the end. They then found another bank who actually then set up within a matter of a few weeks. So, while we're obviously talking about the tax and legal aspects here, my advice to Michelle would be get the company set up and get that bank application going early, and talk to your accountant, talk to your legal advisor to make sure you're with the right team at a bank.
Why does it take so long to set it up? And why would it get rejected?
Yeah, so I think there's kind of probably 3 reasons that I'm aware that the banks are sometimes a little bit hesitant. One is classic risk. Someone like Michelle, she's got no UK banking history, so she's coming here as a clean sheet of paper, as it were, and therefore no track record. The second one's sort of money laundering checks. Again, what evidence does she have in terms of who she is from a UK perspective, and that can sometimes take a little bit more. It's just a bit more risky in terms of money laundering regulations. And I think one of the bigger ones is they've been around a number of years now, but still not loved by the banks in the UK. Is the US FATCA rules, which basically put quite a heavy burden on US banks in terms of compliance requirements, and as a result, quite a lot of banks well, not quite a lot, but there are a number of banks which will say, we don't want to deal with US persons.
Yeah, that's right. I mean, that issue is getting somewhat better over time. And I think on the business side as well, that if the clients come to us, we can oftentimes make introductions to the business sections of banks that are perhaps more familiar, more confident in dealing with people from overseas to help them overcome that. But just coming back to the setting up the company, first of all, explain what Companies House is, what information you have to give them at the beginning, and what information you have to keep giving them on essentially an annual basis.
Yeah, sure. So Companies House is essentially the UK, I suppose, regulator for UK companies. It is a online, freely accessible database. In terms of the information you have to give when you set up the company, it will publicly disclose the shareholders of the company, or the majority shareholders of the company at least, the directors of the company. It will further set out, as the company gets going, financial information in terms of accounts, Any changes to shareholders, changes to directors, they're all publicly published online and freely available.
Yeah. And Christian, I think that's a point that we have to emphasize to Americans in particular, the level of information disclosure given to Companies House, and incidentally, this becomes public information in due course, in terms of who the ultimate owners are, the financial details of the owner. There's much more information in the public domain that I think a lot of Americans actually are going to feel particularly comfortable with, at least at first.
Yeah, I mean, that's absolutely the case. Americans will be used to, sort of, for example, the state of Delaware, where, anyone can form an entity. It doesn't even have to be a shareholder who does the formation. And, the most you can ever get on the Delaware Division of Corporations, it's called, is sort of the name and agent for service of process, which is a third party company for the entity. Here, the idea that they're going to have to provide their articles of association are on Companies House. Their financial accounts every year have to be filed with Companies House. Their name and address is going to be on Companies House if they're a majority shareholder or director. Is something that I've had a number of U.S. lawyers and clients sort of say to me, well, they can't really mean it can't possibly be that you have to provide all that information and it's just everyone can go and look at it. And the answer is yes, it is that way, and yes, you do have to provide it.
Yeah.
And yes, it will be publicly available. And by the way, it's like that in a number of other jurisdictions as well. It's just that the U.S. is particularly secretive,
Yes.
I think.
Yeah, absolutely. But that's just something that they'll want to be aware of in advance. And also they have to disclose director details of who their directors are, down to the level of their nationality. It used to be full date of birth. Now it's just your month and year, but also a service address that, legal papers can be served at, so you can't hide behind a brass plate in some place that no one can get to you.
Which is what they do in Delaware. It's not a brass plate that no one can get to. You can get to it, but the agent for service of process in Delaware is always a third party provider.
Yep.
It is never one of the directors of the entity itself.
So, Liam, once we get over that step, we've set up a company. It's got its bank account. In terms of just the practicalities of running a company, in terms of employees, perhaps bookkeeping and accounts, what are some of the things that someone setting up a company for the first time will need to know about?
Yeah, so there's a few, as there is in the US, there's a few things that need to be done in the UK. If Michelle's going to be hiring employees, she'll need to set up a UK payroll. She'll also need to set up a UK pension scheme for their employees, as the UK, for a few years now, has required UK companies to have a pension scheme for their staff, and actually as employers should be obliged to put 3% of the employee's salary into that pension scheme on top of their salary. Yeah. On the payroll side as well, and again, this is sort of European thing really. There's employers' national insurance, on top of the gross salary. Other things to think on the payroll side are, does she need to have a UK employment contract and getting advice in relation to that? What other taxable benefits does she want to think about? So things like private medical insurance, that kind of thing. That's probably on staff. In terms of, she might want to think, does she want to register for VAT? Again, that's separate registration. She won't need to register until annual turnovers more than £85,000. But she might want to consider voluntarily registering, as VAT is a value-added tax, so she'll be able to reclaim VAT on her costs. Yeah. So in the early days, you might want to do that.
Yeah, and the VAT may be something a very new concept, although you can sort of think of it as equivalent to an American sales tax. first of all, it is much higher. The rate on most goods and services tends to be around 20%. There are some exceptions, but 20% for the most part. And it's a combination of businesses pay VAT on goods they buy, but then they also have to collect it on services and goods that they sell. And there's sort of a fairly complicated netting off impact. But it is one of those areas when most small businesses get into trouble in the UK, it's usually because they've done something wrong on the VAT. So something very important to get good advice and get it right from the beginning. Kristen, you wanted to say something on the setting up stage on the US thought that people need to hold in mind.
Yeah, there's just two sort of points to note here. The first really is a totally practical point, which is that my understanding is, depending on when you incorporate the company, your tax year end from a UK perspective, unless you elect otherwise, is generally based sort of on when you incorporate the company. From a US perspective, that doesn't make any sense. And so to make sure that things line up in the easiest way possible, just make sure that your UK limited company is electing a 31 December year end. And that just makes, that just makes your accountants a lot happier and makes things easier. The second point is a substantive one. And that's, Michelle, in this case, we are assuming she is just going to sort of set up this company and then start the business. But if Michelle is expecting to, if she's come up with sort of a super whizzy idea already and she's got a patent for it, for example, and she's planning on transferring assets to this UK limited company, we've decided earlier that a check the box election probably doesn't make sense in this situation. So the company will be treated as a corporation from a U.S. tax perspective. We have various, again, these are more part of our anti-deferral rules. We have various rules that can tax U.S. people on transfers of assets into non-U.S. corporations, and so that's something else that she will want to keep in mind. If she's just going to start the company and she doesn't have anything and she's not contributing any assets or any IP, then she doesn't have to really worry about these provisions. But if she is, then that's something else to be considering, because it can lead to a sort of an upfront tax charge, or alternatively a sort of 20-year sort of deemed license in certain situations. So just a couple of things to keep in mind as she's kind of moving forward and setting up the company.
In the next step, we'll talk about business growth and expansion. In particular, raising finance to expand the business. So, Liam, what are some of the options in the UK for raising finance?
Yeah, so in the UK, you've got, well, essentially similar. So you've got equity finance and loan financing. They're the two main routes, really.
And are there beneficial routes that, particularly if you want to attract UK investors, are there some arrangements that encourage UK investors to invest particularly in smaller businesses and startups?
Yeah, so the UK's got a very generous tax scheme for UK investors into private companies and especially startups like Michelle's, known as the Enterprise Investment Schemes. The Enterprise Investment Schemes are of two forms: the SEIS, the Seed Enterprise Investment Scheme, and the Enterprise Investment Scheme itself, the EIS. And any UK investors would probably expect Michelle's company to have applied and be able to offer these schemes in respect to their investment. The reason being, SEIS gives a 50% income tax reduction for each pound they invest, up to £100,000 for them, and the company can raise £150,000 total. EIS gives a slightly less, a 30% reducer, but essentially she can raise up to it's sort of millions of pounds under EIS. And on top of that, if an investor is invested under SEIS or EIS schemes at an exit event, their capital gain will be tax exempt, so there'll be no tax on the capital gain on exit. The upshot being that actually for 45% taxpayer, you can end up with a position for EIS where actually, say everything goes doesn't go to plan actually, and the whole business just fails. The investor's only on the hook for sort of 38.5% of their investment for EIS, and only 27.5% for SEIS.
And I just, as an aside, for American investors in the UK, some of those benefits might be worthwhile, but some of them may simply mean giving back more money on the US side to make you somewhat indifferent to it. I think the idea is if you're an American and you're approached about an EIS or an SEIS investment, I wouldn't automatically say no, but you will have to look at it quite carefully. Just moving on, what are some of the issues around debt financing for a business?
Yeah, so a lot of the issues are probably more for Michelle from a more commercial side. She's probably going to struggle to find a bank to lend money to her, and actually that's part of the reason why the government's introduced things like the SEIS and EIS schemes. Obviously, as a new business, she's got no track record. Okay, depending whether or not she's putting any assets in there, but if it's kind of a tech business, she probably has a limited asset, so there's no security there for the bank. So I think external debt financing is going to be a problem. She may be putting in her own money in terms of shareholder loans, which is probably the only debt the company would have. But actually, as an American, there can be implications on that. And
yeah, I mean, Paul, I don't know if you guys run across this a lot, but, the U.S. has certain debt equity rules. And basically those rules kind of look at whether or not they think something looks more like debt or think it looks more like equity, regardless of what you call it. And so, if you have a shareholder who is loaning in £100,000 and, the theoretical equity is, £10, the U.S. tax authority just says, forget it. None of that is debt. It's actually all equity. And of course, the implication then is that, and you guys, I'm sure, see this, Paul, is that you have something that's a little bit of a sort of hybrid. It's a debt from a UK perspective, but it's equity from a US perspective. And do you guys see that a lot? What do you do in those situations? Are there mismatches that occur?
There certainly are. We do see it quite a lot, whereby they may not have taken the US advice straight up, and it's quite common for UK companies, startup companies, to be funded with a shareholder loan or a director loan. And in that instance, from a US tax perspective, if you draw down on your own in the UK, there's nothing. But from a US perspective, that'll get taxed as income. So you do get a mismatch, and that's where. It's one of the few situations where there's no relief under the treaty. None of these elections are going to get you out of it, and you end up with a US tax charge.
Mm-hmm. Yeah, and it might be depending on what the numbers are. Again, maybe it's better to do it that way and just eat the US tax charge, but it is just something, it's a mismatch, and a lot of what I think we spend our time doing is trying to make sure that the tax systems in both jurisdictions are as aligned as possible. And so it's just something to be aware of, I think.
And finally, what about raising finance at this stage through bringing on new shareholders, but not necessarily through a public offering? What are some of the corporate finance steps that they might consider at this stage of the business?
Yeah, so early on, for a business like Michelle's, depending on what her product idea is, but she's probably going to be looking at sort of friends and family to fundraise, to get the business off the ground. As perhaps the product gains traction, she'll then probably start looking at, can she get venture capital funding? Can she get private equity? Perhaps angel investors? Again, actually, having a UK limited company and being based in London, actually, it's certainly a growing network, and getting corporate finance advice can help kind of maximise the value, minimise the dilution she suffers, so I personally recommend that actually, once you're starting to do proper fundraising from third-party investors, get that corporate finance advice.
the final step we want to talk about today is exit strategy. So, looking down the road, Michelle's business has been very successful, and in some form, she's had either an offer to buy or an offer to take the company public. What are the steps that we want to think about at this stage?
Right. Well, I mean, I think one of the first steps is going to be to make sure that we talked about corporate finance a little bit earlier, but make sure that she has a good corporate finance team on board. I think the other thing is going to be whether, if she is if she's not going public is kind of a totally different sort of route. But if she's, let's say that this is sort of a private equity deal and she's going to retain an interest, but the majority is going to end up with the private equity or the venture capital fund. I think there's going to be a number of sort of things to think about, both from a commercial perspective, but then also from a tax perspective in terms of what that transition looks like, and how it's going to be structured. So I think getting the corporate finance team on board first, but then sort of very promptly kind of moving to the tax aspects of what that looks like, because of course depending on what the deal is, if sometimes the deal is that the management team sort of cashes out and reinvests post-tax, and that's a pretty easy, straightforward kind of scenario. But there are other scenarios where the intention is that the top-level management, which surely would include Michelle, are going to be expected to reinvest in the new structure. And how does that work if there's expected to be a sort of tax-free rollover component to this new structure? How does that work from a UK perspective? How does that work from a US perspective? And how do we make sure that those two things sort of are aligned? So that's kind of the sort of process, I suppose, of that. But one of the tax points really is going to be, well, if I am cashing out all or some, how much tax am I gonna pay on that? And at least from a U.S. perspective, we would expect that if she has held the shares for more than a year, that when she sells, the rate of tax is going to be at the long-term capital gains tax rate. It is possible some of that will be dividend income for some complicated reasons, but at the moment, the dividend rates and the long-term capital gains tax rates are the same in the U.S., and certainly quite a bit lower than the ordinary income rate. So, certainly the target is going to be to sort of slot into that long-term capital gains / dividend, qualified dividend income lower rate, and make sure that it's not being taxed at ordinary income rates from a U.S. perspective, at least.
And Liam, what do we want to think about on the UK side?
So from a UK side, I think it's always about sort of advanced planning. From a corporate level, it's kind of making sure that actually she's got her business sort of things lined up. So if she is taking on external investment, or she is looking to list, or however the exit's taking place, that actually things are all lined up. So when a due diligence comes along, that isn't raising unexpected questions. It was actually a clean, straightforward due diligence. Then obviously gives the buyer or the investor confidence, which then means she's not getting any sort of knocking back of value. And that's something that really she needs to sort of do from day one right through to exit, since if you don't get your EMI scheme sorted out on day one, then actually that's a whole bunch of unhappy employees when you come to exit. Certainly UK employees. So if you don't sort out your SCIS, EIS, you've got some unhappy investors. These are the kind of things to make sure you're aware of and getting good advice as you go along, really. There's possibly a few bits on the personal side for her as a UK resident shareholder. She might want to think about business asset disposal relief. There's kind of the interaction with the US tax. I don't know if you want to elaborate on that, Paul.
Yeah, so for US shareholders and UK companies, if they're going to be qualifying for the business asset disposal relief, it doesn't really help them out that much, because generally in the US they'd be paying the US rates, because the US rates would be higher. So the business asset disposal relief currently gets it down to 10%. However, you would still want to structure your business in a way that you're going to, at that point, you will have, you may have other UK investors, and they will benefit from the business asset disposal relief and the beneficial rate. So it's important that any structuring and any options do qualify for that.
And I think, too, for some of our clients, it's an interesting time in their life when this event is happening, particularly if the amounts are significant. It's a time that many of our clients will be thinking that they want to devote part of what they've realized through this to some charitable or philanthropic endeavors. And again, there's some opportunities they might want to look at before they actually sell the business of perhaps making those contributions in the form of shares before the sale rather than cash afterwards, and there's some interesting opportunities for them to look at there. I think it's also useful, particularly, Liam, if we're talking about someone who's been in the UK for quite some time, there might be some advantages to settling their shares into a trust before the disposal, not so much from a capital gains planning standpoint, but from an inheritance tax planning standpoint, if those assets qualify for business relief in the UK. So obviously there's a lot of complexity here, but there's lots of opportunities for planning. Perhaps each of you can just tell us briefly what it is your teams can do to help a client in Michelle's situation.
Yeah, sure. So Butler Snow is a full-service law firm, but we have a London office, and that London office is really focused on people like Michelle. And we provide the range of sort of tax planning services from a US perspective. We're all US qualified with respect to whether it's the business and her holdings, or with respect to how she herself owns those shares. Any trusts, we just talked about potentially settling some of the assets on trust. We're able to advise on the US aspects of that, as well as any of the sort of corporate tax aspects that we've talked about, Paul talking about the controlled foreign corporation rules, any of the investment considerations, exit strategy. So really sort of the life cycle of the business from a US tax perspective. And it's quite helpful. We've all my two partners and I, we've all practiced in the UK for a number of years, so we're quite familiar with the UK system, even if we are not ourselves qualified in the UK. So we at least have a good starting point for when you guys start talking to us about all of the UK rules.
Yeah, so as you know, the tax affairs of Americans living in the UK are very, if ever, straightforward. And as we discussed today, you throw in the complexity of a company, and things can get very complex indeed very quickly. So we can help US individuals who are looking to set up a business in the UK, or even if they currently already have set up a business in the UK. We can draw on the expertise of 60 dual qualified US UK tax advisors, as well as working in tandem with our corporate tax team, as well as an attorney such as Kristen, and we'd help guide clients through the whole process from start to finish. And the tax implications thereof. Obviously, no two businesses are going to be the same. What works for Michelle may not work for others. And in that situation, we always advise the professional advice is taken as soon as possible, and preferably before the business is actually set up.
So I think for Michelle, it's really important actually to get that advice from startup through to exit. From Buzzcocks corporate team, we work with businesses for each stage of that journey, and work closely with teams like Kristen's. Obviously, work closely with our expatriate tax team, which Paul's part of. To deal with some of the unique aspects that actually being an American, trying to set up a business in the UK brings. Ultimately, I always find that while there's complexities at a startup and along the way, there's always a way to commercially get where Michelle needs to get. It's just getting that right advice to make sure that you're not falling into any pitfalls, and actually you're benefiting fully from the opportunities. In addition, as part of the corporate side, there's our corporate finance team. So they're very much able to help in terms of supporting fundraising, making sure that the business is being presented in the best light to kind of maximise value, and on an exit, making sure that actually everything's lined up. So you've got a clean exit and a maximised value on exit.
Thanks to our speakers for joining us today, and thank you, our listeners, for tuning in. Please plan your next step by looking at the other episodes in this series covering the topics of property, children, investments, and more. Thank you.
Thank you.
Thank you.
Thank you.
This Stepping Stones podcast is brought to you by Buzzercott, a top 20 UK accountancy firm based in London with a team in Hong Kong specialising in US and UK tax, financial planning, corporate business services and audit.